Welcome to Section 1, Lesson 1 in Becoming a Trader course. Section 1 is called Introduction to the Forex and Futures Markets. And in Lesson 1, we're going to talk about what are the Forex and future markets. Well, the Forex and future markets are two of the largest financial markets in the world. Forex, or also known as foreign exchange, is the market where currencies are bought and sold. For example, when you go to a different country, you got to buy their currency with your currency, and there's an exchange rate of how much you'll get. For example, I go to Colombia a lot. I get $1 to 45, 46, somewhere right around there, 100 pesos. And it changes every time we travel there. So if it's really strong, I like to get my currency ready for my next vacation because I'll get more of their money. So when I do travel there, I get more out of my vacation. Just something you could use Forex for in real life and not just trading and making money. The futures markets are the financial contracts that obligate the buyer to purchase an asset or a seller to sell an asset at a predetermined price and date in the future. Both markets are based on the principle of supply and demand and are heavily influenced by global events and economic indicators. Traders in these markets use various strategies to profit from price movement and volatility. Something to keep in mind is that these markets work together. We'll dive more into this in our advanced trader course as it gets really advanced. We'll also dive deeper in becoming a trader course just to get you a little more understanding of this. But for now, let's keep it simple, get you ready, get that foundation built so you can become a strong trader. So what are the differences between the Forex and future markets? Well, as we quickly went over in the previous slide, Forex markets are where you exchange currencies. It's a decentralized market, over-the-counter market, that deals with the exchange of currencies. This trading happens 24/7 and the market is highly liquid. So for you as a Forex trader, you could actually trade almost every single day, 24/7 hours a day. Now, the actual live markets do close for a short period from Friday to Sunday, but in the real world, you could actually purchase currency any time of the day or week. Futures markets are centralized markets that standardized contracts are traded on the exchange, deals with buying and selling of contracts where the delivery of the underlying asset is made at a predetermined future date. So when you're looking in on TradingView and whatever broker you're going to be using, you'll see that there's March contract dates, there's December, and it's going to rotate. So you need to pay attention when the liquidity goes from the March contracts and starts shifting to the next predetermined date contracts. You're going to want to make sure you switch over and start trading those contracts because that's where the liquidity is going to be, and that's where you're going to be able to buy and sell much more easily than on a dated contract or something that's too far out in the future. There may not be a buyer or seller willing to partake with whatever you want to do in the market. So key differences: the Forex market, no central exchange, lower capital requirements, higher leverage, and higher liquidity. Future markets have standardized contracts, are traded on a central exchange, and usually have a higher capital requirement and lower leverage and lower liquidity. What this means is currencies run the world. So everyone is going to be buying and selling currencies. A bunch of little stores that do currency exchange, they got to buy currency so they could resell it to people that are traveling. So there's a lot of money flowing through Forex because it's a representation of the currency of a country or multiple countries that use it. Anything that happens in those countries are going to highly affect the currency. And when they're paired up against each other, something really good could be happening over here. Something really bad could be happening in this country. So the exchange rates skyrocket, right? So something to keep track of economic events and everything like that. But that's not to say the futures markets don't have the same thing, because you could be trading commodities. Like I've seen people trade oils, which is kind of normal, gold, silver. People even trade like eggs and stuff like that. You can really trade a lot of things. I just stick to the E-mini S&P 500. That's my main future contracts I trade, and I stick to that and some Forex. So let's talk about the market participants and their roles. Just know that us retail traders are the target of these banks, hedge funds, and corporations. There's always a winner and a loser for each trade. So if you're winning, someone's losing. And if you're losing, you're pretty much giving that money to somebody else as they're going to be the winner of that trade. So money does not print from thin air. People like me and you, banks, all that stuff, we put our money in and we exchange it in favor and hopes that we win and get more money back. Doesn't always work that way, and we'll talk about later in this course of ways to protect your capital and make sure you get a consistent drive when trading in the markets. So let's talk about them. The Forex and future markets involve various market participants. Everyone has their own roles and different goals. Primary participants in the Forex market include banks, hedge funds, corporations, and retail traders. And you're probably thinking, corporations, what do they got to do? Well, if a company like Apple is doing business in other countries and they're selling their products, if they're going to be doing work over there, they got to convert their American dollar, the USD, into that currency of that country so they could build their stores. Maybe they're in China, they're building their phones over there, so they probably pay them. I'm not saying I know exactly what's happening. This is just an example of what could happen. They pay them in the Chinese dollar. I don't remember the name of it, or if they're getting paid, they're selling their phones locally and they're getting paid a bunch of that currency, they want to convert it back to their US accounts. So that's why corporations are a big factor in Forex trading. And then you're saying retail traders. What's retail traders? Well, that's me and you. That is someone who is in the market, personal capital, or they're getting funded, but we act solely by ourselves, and big banks and hedge funds are looking to take us out, take our capital so they could hold it for themselves. The futures market participants are a little bit different, but for the most part, it's the same thing. You got people like us, you got the hedge funds, and then you got the bigger capital, could be the banks as well if they're protecting their money, or it's just the market makers, right? Now, banks are going to be the largest players in both of these markets because they have the ability to move the market with their vast resources and expertise. So you, as a trader, want to understand what dumb money is doing and how you could get in line with the banks, the people that most of the time win every single time, and you want to ride with them. And that is what we're going to teach you in the long run over here. So stick with us, go through the exercises, and you're going to be able to get a good foundation and put your best foot forward when trading in the markets. Last slide for this section is understanding currency pairs and contract specifications. So in the Forex market, there's going to be two currencies paired together. For example, the one I trade the most is the euro dollar. So they have the euro against the dollar. If the euro goes up and the dollar goes down, this pair is going up. If the dollar gets stronger, euro gets weaker, that pair is going to go down in price. What also makes the Forex market a little more tricky is that each pair, the pip, is going to be valued differently, or tick value. The contract size and quotes are going to be different, as well as the spreads. So it's not as easy as jumping in between markets. You're going to want to pick a pair and stick with it and learn it. Most people stick with the euro dollar or GBP, JPY. Those are usually the main two you're going to see most traders trading with. And for the example at the bottom, the euro dollar has a standard contract size of 100,000, which is a standard lot. So if you were to buy one contract, every little tick is going to be plus or minus $10.